All right, folks, welcome to Investing for Beginners podcast. Today, we're going to start a new series. We're going to have a 12-month series where we're going to break down parts of the income statement, the balance sheet, and the cash flow statement. We're going to do one a month, so you'll have to come back every month to get updated on what we're going to do. We're going to focus on education and we use real life as a FinChat to help us with that. And so we're going to talk about gross margins today. Gross margin is an unloved, underappreciated margin, doesn't get talked about nearly enough. And there's some really great insights you can learn from the gross margin, which we will discuss today. So, Andrew, let's what is gross margin? Let's start with the easy part.
Yeah, let's do gross margin. To me, I like to visualize it. And actually, the way I learned it, rather than trying to read a definition from a textbook, was seeing it on an income statement. And not an actual income statement, because those are confusing, but an income statement that's kind of laid out and organized by an aggregator. So in this case, we're going to use Netflix because that's going to be a really good example for our teaching lesson today. And for those of you following along at home with one hand on the laptop and another hand, hopefully not driving, you type in the ticker Netflix on FinChat, go to the financials tab, and then right there, you'll see the income statement. So you really have kind of like three line items leading to this gross profit and then this gross profit margin line item. So you have total revenues at the top, and then you minus cost of goods sold, and then that's going to give you your gross profit. It's as simple as how much money did you bring in? That's revenues. How much did it cost you to create the product that brought in the revenues? That's cost of goods sold. And then what's remaining after that? That's gross profit. So we're not talking about every cost to run a business. We're strictly talking about the cost for that particular good or service. In the case of Netflix, they make content and they also have to host the content. And so those line items will go in the cost of goods sold, and that turns into gross profit.
Great explanation. I like the way that you visualize it too, because that helps put it into perspective. And to your point, I was looking at a company the other day and they literally did not list out the gross profit. They put the cost of goods sold in with all the other expenses and then just gave one total operating expense, which is fine. But if you want to visualize it on the financial statement, not every company is going to do it because by GAAP rules, they don't have to. And so sometimes companies don't want to. So for whatever reason, but it can be a little deceiving. So I like the way you visualize it. And like you said, using an aggregator like FinChat can make it more visual and help you see. So I guess when you're looking at this particular line item, like what are things that are important for you to see? What are maybe some green flags and maybe what are some red flags if you're looking at this?
Yes, good question. So gross profit margin is going to be a percent after you take out the costs. That gross profit is a percent of revenues. And so what you want to see ideally is at least flat gross profit margin. And then if you're expanding gross profit margin, that's even gravy on top, because that means you are growing your sales faster than how much it's costing you to make. And that can indicate several things. A lot of times investors like us use it to look for pricing power. So if a company has pricing power, even though inflation might make the cost of a cup of coffee go higher, if Starbucks has that pricing power where they can increase prices higher than inflation, you could see gross margins expand, and that can be a good signal of pricing power. But that's just one of many signals.
Yeah, for sure. For sure. One of the things that I think people should understand is when you're looking at this, a lot of times the companies won't specifically tell you what's included in the cost of goods sold. So since it may be a little bit vague on what it is, but just think about it, or at least the way I try to think about it is think about what is involved in making the product that they sell. So for example, with Netflix, like Andrew said, the cost of hosting. So where they host the videos and how they distribute them via streaming is obviously a major cost. Content. So the content that they make or the content that they buy, that would also be a major cost of goods sold. And also the people that do all the work for those things could be lumped in under cost of goods sold too. So this is just one example. If you go to Walmart, it would be similar. So that's one thing you want to kind of think a little bit about when the company is talking about those different parts of the business. Sometimes that can give you some clues on what's really going on with not only just the operations, but also the expenses or the costs to produce what it is that they sell. And so the growth can a lot without really having to think too deeply about the company, and it can be very, very helpful. What habit of comparing a gross margin from one company to another? Now, I know Netflix is a challenge because of what they do, and trying to find air quote pure play other streamers is difficult because Disney Plus has all those other businesses. You know, I can't keep track of what streamer goes where because it seems like they change every other week, so it's hard to keep track of all that stuff. But easier to comp like a Walmart or a Costco or a Kroger and Costco, the companies, are those things that you'll do when you're looking at businesses, is try to compare like how profitable this company is versus that one?
Oh, 100%. So that's a good question. And a good example to me, I think is really easy, is the sporting goods industry.
Yeah.
In the United States, there's three really big players that are publicly traded. It's Dick's Sporting Goods, a company I own, Academy Sports, and Big Five Sporting Goods. So you obviously want to check market share. How big is a company compared to its peers? And then you also look at gross profit margin, like we've been talking about. So if I use the charting feature and I pull up Dick's Sporting Goods, Academy Sports, and Big Five, you see all of them kind of move in tandem. And that sort of makes sense. Something like sporting goods retail is cyclical in a way, it has its own cyclicality. The managements at those companies would argue that even in a recession, sporting is a good place to be because people retreat to sports when the economy is not good. That's up for debate, but we won't hash that argument. But it's good to know. It's good to look at, and you can kind of, to your point about understanding about a business without having all the facts. If you have gross profit margin, you can start to figure out kind of what pricing strategies companies might have. So in the case of Dick's versus Academy versus Big Five, Dick's Sporting Goods is the leader. It actually overtook Big Five and they kind of flipped. So now Dick's Sporting Goods is the leader, Big Five is not. You would want to use that plus what's happening with revenues to try to tell yourself, is there somebody who is leading the pack? Is there somebody who's pulling away from the pack? Is the industry getting more competitive and everything's kind of reverting to the mean? So you can look, and if you see, like in the case of Dick's Sporting Goods, you see revenues that are outpacing competitors and gross profit margins that are above competitors, that's probably a good sign that they are leading and expanding their lead.
Mm-hmm. Would you say that an indication of a potential moat or competitive advantage, especially over competitors, if you see those kinds of things?
Yeah, I would say yes with the caveat. So let's use another example to kind of disprove this theory. So we have Costco versus Walmart as another good one. And I'm using the same charting feature and I'm looking at Costco and Walmart. Completely different story. Walmart has a double gross margin than Costco. However, if you know Costco's business model, they intentionally take such a small percent of the price. They sell stuff and mark it up at such a small percent compared to maybe Walmart or Amazon will mark up prices higher to get a higher gross margin. And so if you didn't understand Costco's business model, which means you haven't listened to our podcast because we've talked about it way too many times, you'll understand that Costco does low prices on purpose to get membership income. And so really their profits are driven by membership. It's not driven by the actual products they sell. So then gross margin becomes not an indication that Costco has a weak moat. In fact, it confirms what we know about their moat. So you do take on a case-by-case basis, but I think in general, you can use a lot of takeaways. Gross margin is better if it's higher against peers. And if it's pulling away from peers, that's even better.
Mm-hmm. Yeah, that's great insight. And I love the person to Costco and Walmart and understanding the business model, because that really goes to that. And talking about pricing power, if you look at Netflix's gross margins over the last 10 years, they've boomed, and it's in large part because the company has been raising prices. And so between raising prices and changing plans and all that gobbledygook, they've raised prices slash changed plans 8 times in 10 years. For that time, we've also seen the gross margin grow substantially from that time, which to me, that they have pricing power. I know that another thing I want to kind of drop about this whole pricing idea, when you listen to earnings calls, you will oftentimes you'll hear analysts talk about pricing, and what they're getting at is, depending on the business, it can be as easy as a company sells a unit and they sell it for a certain price. And if they raise the price on that and the cost of that unit that they're selling doesn't improve, then they're going to have more profitability. And that's why the analyst asks that question, is because they're trying to get at what's driving profitability for the business as well as revenue growth. So raising prices doesn't just hopefully it doesn't just raise the roof on the revenues, but also raises the roof on profits as well, because that leads to the bottom line, which leads to free cash flow, which leads to more reinvestment, and it's just kind of a cycle. And so that's why companies will focus on that, and it's really important. But unfortunately, not every company, Walmart doesn't tell us how many pairs of jeans they sell, or how many bags or salad they sell. So you don't know unit wise how that really go. Now, to give you an example of this kind of idea in the reverse, Sweet Green, which is the sells very expensive, high, shishi salads, if you will. They are actually losing money on a basis. Now they're making it up in other places, but when they sell it, they're actually losing money on it because it costs them more than what they charge. And that's not a great place to be. And as a former restaurateur, that gives me the heebie-jeebies when I heard about that. I saw an analyst that was kind of backing out the costs of what a salad would cost for them to produce and make. And so it's not a great place to be. So those are things that you can pick up by looking at gross margin. And it can be very helpful to kind of dig into this margin and think about it a little bit more, like, oh yeah, hey, there's gross margin, that's what it costs, and moving on to the next part of the income statement.
Can we talk about some of the negative things, or kind of things to watch out for when it comes to gross margin? Because I think it's easy to paint a positive story, like I did, obviously, on the companies I own.
Right.
What are some reasons that a company's gross margin could go in a way that's less appealing?
Depending on what they sell, it could be as simple as the inflation, for example, could cause margins to go the wrong way, because if the company is having to pay more and they may or may not pass it on to the customer, let's say they don't pass it on to the customer, then that cost will eat into their profits. So just to use an easy example, if Nike is importing a shoe from China and it costs them more to sell here in the United States, and they don't pass on that extra cost, then that could eat into the margins. I'm not saying that's definitely one thing to look at. It also feed into something like strategy. For example, PayPal is a company that has seen their gross margins fall over the last 10 years, in large part because the company switched directions of their business model. So everybody knows PayPal for the button. You click the button, you pay for things easy. That was also a very high margin business for PayPal. And when the company decided to kind of pivot and switch to using more on Braintree, which is a segment of their business that is focused more on payments. So when you go and make payments at Costco, Walmart, those places, it could be using Braintree. I'm not saying they are or aren't, but that's what they were doing. The problem is that to try to win business, they went the low-cost provider route and got into a pricing war with competitors. And so they're all trying to undercut each other, and it became a race to zero. And as they won more business, which was great, the flip side of that is that their profitability went, and so because of that, you see gross margins falling off a cliff. And so when you look at the chart on FinChat, you can see that it dropped from 51% to 41%. And you may be like, yeah, big deal, Dave. That's 10%. Whoop-de-doo. That's when you're talking big numbers like these companies are producing, that's billions of dollars you're losing in profits by this making this decision. And they weren't making it up by revenues ramping, exponentially so that could offset this. And so when those kinds of things happen, that's when it could definitely be a problem.
I really like your point about what you're saying. Like, okay, gross margin goes from 50 to 40. Who cares? Um, what's nice about using FinChat is even if you're not a numbers person, you can still use it and it'll do the math for you. So if we use that example, we can click on revenues and we see, okay, 10-year period, it's up 14% a year. But if gross margins came down by that 10%, we can click on gross profit and you can see gross profit was only up 12%. So instead of growing at 14%, your business only grew at 12%. That's not ideal. That's still a pretty nice growth rate. Not going to lie. We're not looking at operating margin or operating income or anything like that. But it does show you that when gross margin contracts, you're not going to get all that revenue growth is not all going to flow into profit growth. And so you have to be careful if you're expecting all the revenue growth to become profit growth. That kind of mistake has hurt many, many investors. The growthy graveyard is full of those type of investors.
Yes, it is. And digging in a little bit deeper on the PayPal story here, if you use the slider and kind of narrow the time frame. So, for example, around 2021 is when the company started really making this pivot to Braintree. And if you can track the time period and you see a even more different stark story. So you see revenue growth of only 7% over that period, and you see the gross margins dropped 11%. Or as the company has scaled up its revenues slowly, it is also losing profitability over the same period of time, and that is very much a red flag. And that it also explains why the company went from a high of $195 a share to a low at one point of around 55, 60 bucks a share. I'm not sure where it's trading at now. Actually, I could just look. It's at 72 now. But as a mostly former bag holder, I can see this helps explain why the company's fortunes in the stock market have taken a tumble and have struggled to get back to where they were before.
Yeah, I mean, 3% profit growth a year is not going to fund many retirements.
I know it is not, especially not mine.
I guess Disney is another good example of this. And I like how you mentioned like zooming into the particular instances of where things kind of started to unravel. So for Disney, that started in 2018-ish, which is a year before I bought. And so I bought into a pretty bad situation that continued getting worse. And a lot of that kind of, to your point about the Braintree thing, what's another race to the bottom? Streaming, right? The whole Disney Plus versus Netflix versus HBO Max, all these platforms. Hard to say if that's really a profitable thing. Netflix seems to be the only one kind of emerging from that. But in Disney's case, finding gross margin collapse from 44 down to 32, finally rebounding a little bit up to 37. But to go to the whole gross profit story, we're talking about 4% a year in gross profit from 2018 to now. That's not going to do it if you're trying to beat the market.
No, not at all. Not at all. Are there any other things that you see in gross margins that would maybe not have you run for the door, but certainly give you pause?
I would say I'll use another one of our companies to kind of beat this up even more. Hopefully we're learning. Starbucks being one of those where gross profit margin is contracting, and not because of pricing, but because of traffic. So we're looking at a company that used to be in the 30s is now in the 25-ish range. From a gross profit perspective, 4.5% a year. It's not great. They have done a lot of buybacks, so that's kind of helped cushion the impact of that for investors. But you can see the dichotomy in that if you go to the segments tab for Starbucks, segments and KPIs, and they have average ticket growth, and then you have comparable transactions growth. Ticket growth is healthy. You're seeing ticket growth year after year after year, but particularly lately, -4% on comparable transactions growth is telling you that traffic is going down, even though the prices they're charging are still going higher. Now, there's a lot going on in that company that hopefully right the ship. And obviously, I believe in that turnaround, but time will tell. And so I think that's another thing you can do is you can use supplemental KPIs. And if you're familiar with the business and you know what those KPIs mean, then it can tell you, help explain that gross margin story. And so in the case of Starbucks, it's not a pricing issue per se. I mean, you can argue people not showing up is kind of them reacting to the price, but really the numbers are showing that traffic is down, gross margin comes down.
Yep, exactly. One of the metrics that I don't use a lot because I don't invest in these kinds of companies, but I think it'd be very helpful if you invest in more early stage companies that maybe aren't profitable operating wise or overall income wise. And it's a metric called price to gross profit. Brian Feraldi introduced it to me. I had frankly never heard of it before, but it can be very helpful when you're trying to not necessarily value companies per se, but it can give you it's a good relative metric to use if you're comparing earlier stage high growth businesses that aren't profitable yet. It's a way that you can measure, okay, compared to other peers, how is this company faring compared to its brethren? And so it's not, again, you and I deal more with more mature, profitable businesses. Using a price to gross profit for Visa and MasterCard is probably not the greatest use of the metric. But if you're looking at, I'll just pick on some, let's say Datadog, CrowdStrike, MongoDB, and Sentinel. If you wanted to compare those companies roughly in the same area, you could look at the price to gross profit, and you could pull that up very easily on FinChat, and you could just kind of see relatively in the charting section. You could see relatively, okay, how are these companies faring?
You could use price to gross profit margin not as a valuation metric, but as a tool to gauge Wall Street's sentiment on the different growth stocks.
Yeah.
So if Datadog has a higher price to gross profit than, I don't even remember what the other comparison was, CrowdStrike or something.
Yeah.
Then that would tell you Wall Street likes that stock more than CrowdStrike.
Yes. Yeah, exactly. Yep. That's an easy way to use it to see, the sentiment as well as how profitable this business is compared to the price.
Right.
So, again, not a great metric to use for something like Google or Amazon or Microsoft, but for early growth stage companies, perfect.
Well, I hope all of those lessons were helpful. I hope that makes sense and you can start to use gross profit margin in your day to day as you start analyzing income statements. I'll go back to the charting section one more time because that's so useful for looking at gross margins and kind of comparing things. So I typed in gross margin and then I typed in the companies that kind of pop up as your first defaults. So it's all the biggest companies. And you can very quickly visually see which companies are kind of seeing the expanding gross profits and which ones are seeing contracting. And sometimes that can help kind of inform the narrative. And sometimes there's very logical reasons why. So between Microsoft and NVIDIA, which one of those do you think is expanding and which one do you think is contracting?
Oh, I guess my first instinct is NVIDIA going up, Microsoft going down, but
yes,
what's the story?
Yep, that's the story. If we're looking at like a multi-decade time frame. So maybe I should zoom this in a little bit so we're just looking at the last 10 years. Okay, so they're both going up. Microsoft slightly going a little higher.
Right.
So that makes sense to you because
because a combination of AI and cloud computing is all the rage in the market right now. And Microsoft is one of the leaders in the cloud and AI. And NVIDIA is the dominant leader in the creation of chips to create AI. So that makes complete sense.
Yeah. And Microsoft going from gross margins in the 80s to like the 60s
Mm.
kind of shows their transformation from a complete software company with really high gross profits to a more capital intensive cloud computing company where those gross margins are a little bit lower because they have to buy up all these servers, but they're still really high compared to most businesses.
Yeah. Yeah. There's a lot of companies that would kill for 60% gross margins, right?
Yeah, yeah, for sure. So let's talk about the next two on the list. Apple and Amazon both have expanded their gross margins quite a bit. And we touched on this a little bit earlier, but maybe these are now tangible examples. So talk through why did these companies see expanding gross margin?
Well, I'm going to let you tackle Apple because I think you know that better. I would just be speculating. With Amazon, I would say it directly correlates with AWS. AWS has become a bigger and bigger part of Amazon's business. I think it's a little over 110 billion in revenue now. And as that becomes a bigger portion of the company's revenues, it's a much higher margin business than the retail part of the business, which is not, decidedly not. And so because of that, that's why Amazon is starting to see more expansion in their margins kind of across the board, but particularly with gross margins, you're seeing them rise quite a bit. And it directly relates to that and some air quote efficiency gains as well along the way, but it's mostly AWS.
Yep. And Apple is a similar story. I mean, you kind of touched earlier about the idea that if a company's changing their strategy a little bit or getting into a more profitable, higher profit margin business, then that can naturally expand your gross margins. And that's what Apple has done with the services business. So they have the same installed base. I mean, it slightly grows installed base, meaning iPhones, iPads, MacBooks. But the services component, all of the software, the app revenue, all of the things that encompass services for Apple is so high margin that it is pushing gross margin higher and creating faster profit growth than their revenue growth. So the next two, and it's funny how these are kind of like paired. And so it makes for fun comparisons, but Alphabet and Meta.
Ooh. I would say that I would say they're probably similar.
Yes.
Like not really going up a lot, but probably not going down a whole lot either. Just kind of steady state.
Yeah. I mean, you're right on the mark. Slightly down for both. Meta from 84 down to 82, but that's not even 10% of 84% would be 8%. So we're talking about half of that. And then similar for Alphabet from 63 to 59. So, yeah, margins down a little bit. Both of these are advertising businesses at their core. Google search being an advertising business, Meta being an advertising business. It's interesting to like chart it and see how closely their gross margins follow each other.
Right. And the other thing that's interesting too is they're also spending, gazillions on the CapEx to build out the AI part of and cloud part of their business. And so it's interesting to see that they're still really high margins businesses and have gone down a little bit as that money is being spent to expand on that, but it hasn't really impacted their financials as much yet.
Yeah, it's amazing. I mean, I remember tweeting maybe 6 months ago something about Meta. Something like, I don't know if it was 42 billion, but it was something over a multi-year span that they had taken as a loss. And yet their growth rate is still in the double digits on a profits basis. So you're losing billions and still growing double digits. It's insane.
Yeah. Yeah, it is insane.
I'll give two that are also related here, and then we'll end on the last one. Saudi Arabian Oil Company, which is short for
Aramco.
Aramco, thank you. And then Tesla. Thoughts there? Do you have any guesses?
Tesla, I'm pretty sure is going in the wrong direction. I think their margins are contracting. Aramco, I have no idea.
Yeah. Aramco is like a steady decline. Tesla is like a sort of like a mini wave. So it kind of came up, it
Mhm.
peaked in the 21, 22 period, and now it's come back down. So over a 10-year span, Tesla's margins are actually slightly down for gross
Okay.
margin perspective, which is
Right.
interesting. And that kind of throws me off because I look at how popular Teslas have become. And it
Mhm.
seems like, well, if they're so popular, they must have pricing power. People must be spending more and more and more every year. And it's not really outpacing their costs
Mm-mm.
to produce, even though they've scaled up so much. The big
Mm-mm.
argument around building these gigafactories is as you get scale, you'll get those economies of scale.
Right.
But maybe it's a demand thing or whatever it is. The revenues are not keeping up with. So that's shocking to me.
I think it relates to, again, I don't follow the company that closely, but I think it relates to they were lowering prices to try to stimulate moving the units. And I think it's been over a year and a half now. They've been doing that, maybe a little longer. And so I think that's what's eating into their gross profits because they're just charging less for their cars. And that's causing their margins to go.
Yeah. On a side note, like you've seen Cybertruck, obviously.
Yeah, I saw one yesterday, actually.
So have you seen the new Teslas that look like a Cybertruck, but it's just a regular like SUV? So it has like the kind of like
Mm-mm.
the Transformers, like uh I don't know, like the front. You know what I'm talking about? The front of a Cybertruck kind of looks like a
Yeah.
Transformer, kind of with like eye slits, kind of thing. Like
Right.
super
Yep.
dope. My daughter does not think so. I think so.
My daughter does not either.
I mean, they have Teslas like that now that are SUVs. So I thought it's interesting. Maybe that was a way to get that into market by
Yeah,
doing a
could be.
ridiculous thing. You shock them with something ridiculous, and then you kind of
Right.
ease them in with this thing. Do you like
Yeah.
that look? Do you like the Transformer look? Just the
I thought it
slits.
was fine.
Okay.
You know.
Yeah.
I mean, and yeah, my daughter was like, "Ew." I was like, "Look, hey, look, it's a Cybertruck." She's like, "Ew," and it pulled behind me so I could kind of see it through my rear view mirror.
Yeah.
I was like, "It's kind of cool. I kind of like that." But yeah, she was like, "No, not having it."
So they finally made their way all the way down to South Carolina.
Yeah, Charleston,
Wow.
even to Charleston. I know, amazing.
The claw has gone far and deep. Okay. Last one on this list. Broadcom.
Huh?
What would be your guess?
Going up.
Going up. It is very much so going up. You can put a lot of different semiconductor companies on here. TSMC, ASML, a lot of the different chip companies, they're all seeing a huge boom. We will see if that is permanent from AI or if it's just another super cycle in semis. And
Right.
that will remain to be seen. If I
Yes,
zoom
for sure.
out over like a 20-year time period for Broadcom, they've actually been steadily up, 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 up. That's truly extraordinary. All the way down from like 34%. Now they're up at like 75%. So
Wow,
double
that's
gross
awesome.
margin, double
Yeah,
gross margin.
that's
That'll
impressive.
give you a lot of profit growth.
Yes, it will. That will bank a few retirement.
That will bank a few retirements. Very well said.
All right. Well, with that, we will go ahead and wrap up our show for today. I hope you enjoyed our conversation on gross margins. Again, come back next month and we'll talk about another part of the income statement. So, with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.